Hi, this is Jack Crooks from Money and Markets TV. As the economies of the United States and Europe struggle, global investors are looking toward Asia to pull us out of the recession that has followed the credit crunch of 2008. Growth rates in the emerging economies of Southeast Asia have been sizzling hot, and their currencies have soared. This currency appreciation is partly due to the policies adopted by the U.S. Federal Reserve, the European Central Bank, and policymakers in other developed nations. They're keeping their currencies weak to help their exporters and encourage lending. That's forced the hot money to seek greater returns on their investments in other parts of the world, including Asia. That's good for their economies while the capital is flowing in. But in times of extreme uncertainty, those capital flows tend to reverse as investors search for safety in traditional safe havens such as the Japanese yen or the Swiss franc. When that happens, the currencies of emerging nations dive and the cost of insuring their debt soars. And that's exactly what's starting to happen now. Take a look at the 5-year credit default swaps of Thailand, Indonesia, Korea, India, and China. Over the past 12 months, the cost of insuring their debt has been trending higher. But now, take a look at how high those rates went back in 2008, at the height of the credit crisis. I'm not saying these CDSs will surge back to those levels, but if the European sovereign debt crisis explodes into a full-blown disaster, it's certainly not out of the question. The currencies of the emerging markets are showing signs of strain as well. The Singapore dollar, Korean won, Brazilian real, South African rand, Turkish lira, and Hungarian forint have all taken a turn for the worst recently. So these emerging markets are illustrating the threat facing the global economy. But as I mentioned, the threat originated in the Eurozone, and that's where we're already seeing the most dramatic market moves. Banks in both Europe and the United States are finding it more difficult to borrow from other banks. But as you can see from this chart, the lending rates for Europe's biggest financial institutions have soared to much higher levels than their American counterparts. We can see this increased reluctance to lend even more clearly by looking at the overnight lending rates between the banks. Here's a chart of the Euribor, the average rate that 50 European banks charge each other to borrow. It has risen dramatically this year, tacking on 35 basis points or almost 30% in August alone. This means that banks are growing stingier with their money when it comes to lending to other banks, just like in 2008. In fact, the parallels are becoming too obvious to ignore, and I believe they could even extend to gold, traditionally the safest of safe haven investments. During 2008, it fell 30% from peak to trough. If we see a repeat performance, it could be a long way down for the precious metal. So will it be deja vu all over again? We don't know the answer to that, but it's a good idea to tread carefully. I'm Jack Crooks from Money and Markets TV. Thanks for watching.